A few days ago, I was having coffee with a friend who works in energy policy. He was halfway through a rant about the latest carbon tax negotiations, looking, visibly drained by the sheer weight of the bureaucracy and the endless veto points involved. To cheer him up, or maybe to provoke him, I showed him a technical paper that had just surfaced. It was about the East reactor in Hefei, specifically detailing this discovery of a tokamak density-free zone. He glanced at the abstract, saw the complex plasma equations and the mention of superconducting magnets, and just pushed the phone back across the table. "It's just another lab experiment," he sighed. "Wake me up when they actually have a plug in the wall." And to him, it was just a dry academic footnote, a tiny flickering spark in a distant, expensive machine. But that indifference is exactly what's so striking. Because while we are bogged down in the vetocracy of committee meetings and identity politics, this tiny spark is the result of a 30-year engineering roadmap executed with a kind of relentless focus that seems almost alien to us now. It isn't just about physics. It's about a system that has replaced the tyranny of the mediocre with a command structure capable of managing a 100 million degree plasma cloud as casually as a logistics chain. And that instantaneous realization, that gap between his exhausted cynicism and the raw, organized ambition in that paper, it left me with a chilling thought. We've spent decades treating energy as a moral debt to be paid through sacrifice and carbon credits. Meanwhile, on the other side of the world, they've stopped looking at the sun for permission and started building their own. And it raises a question that I think most are too comfortable to ask. What happens to a civilization built on financial abstractions when it is suddenly confronted by a rival that has mastered the ultimate physical hierarchy of the universe?
That is the core conflict we're here to unpack today.
It really is.
We're moving well beyond that abstract policy debate, which, your friend was understandably exhausted by. We're diving into the source material that really defines this new strategic reality.
Okay.
So we're taking the technical paper on the fusion race, and we're setting it against the analysis of the economic systems, specifically this financialization debate, that have created this profound geopolitical dichotomy.
So the mission for you, the listeners, to really see this connection.
Exactly. It's to understand this crucial inflection point. The global race for fusion energy is not just some scientific contest anymore. It's a real-world proxy battle.
A proxy battle for what?
It's pitting competing models of industrial organization, state capacity, and economic growth right against one another. We have to look at this material and conclude that the old phrase, fusion is decades away, is now officially obsolete.
It's dead.
It's dead. The competition has definitively shifted from, purely scientific discovery to aggressive commercial dominance and, maybe most critically, control over the future industrial supply chain.
So we have to look past the glowing plasma.
We have to. We have to look squarely at the money and the governance structure behind it.
Okay, let's unpack this with some hard data then. If fusion was considered this perpetually distant fantasy just 5 years ago, what's the tangible evidence that the investment community and governments have actually flipped the script? Just how rapid has this acceleration been in real terms?
The growth has been, nothing short of transformative, especially when you track the flow of private capital.
Okay.
When we look at global cumulative private investment in fusion, as of June 2025, it has reached an accumulated total of about 9.9 billion euros.
9.9 billion.
Now, you have to put that into context. That is a more than six-fold increase since just 2020.
Six-fold in 5 years.
In 5 years. 5 years ago, fusion was a niche, almost a boutique investment. Now it's a recognized strategic category. This massive injection of capital signals that the market believes the engineering risk has been substantially mitigated.
And that the timeline for a commercial return is now actually viable.
It's viable.
A six-fold increase is staggering. But is this purely, venture capitalists throwing money at high-risk physics? Or is there some kind of government direction influencing these flows?
It's a mix, but a very strategic one. The majority is private capital. We're talking over 6.7 billion euros.
Right.
But public funds are playing an increasingly crucial sort of de-risking role. Governments and institutional bodies have injected around 1.8 billion into private ventures.
And how do they do that? Is it just direct investment?
It's often through grants, milestone payments, and institutional support that's designed to bridge that gap between lab science and industry.
The famous valley of death for hard tech.
Precisely. And on top of that, we see another 1.4 billion coming from hybrid funds. Things like public-private partnerships, state-backed investments. which are particularly visible in places where national strategy really drives the economy.
Like China.
Like China and, increasingly in the United States as well. It's a testament to the belief that the first nation to achieve commercial fusion will unlock just tremendous geopolitical and economic power.
And this is where it gets really interesting for me, though. That concentration you mentioned.
Yeah.
This isn't some global free-for-all where every major country has a balanced ecosystem. It's a focused competition that really mirrors the current geopolitical landscape.
It is overwhelmingly duopolistic, and that should be the first strategic insight you take away from this data.
A duopoly.
The United States and China account for a staggering 85% of all private fusion funding.
85% between just two countries.
That's right. The U.S. leads. It's secured about 6.1 billion euros, which is 61.3% of the total global private investment.
Okay, so a clear lead.
A clear lead, but China is a very strong second. They secured $2.4 billion, which is 24.4%. This is a two-horse race, and the strategic divergence between how those two horses are being funded and trained is the central conflict we really need to understand.
And this data has prompted a very specific warning from within the U.S. government structure itself, hasn't it?
Mm-hmm.
The U.S. Commission on the Scaling of Fusion Energy, the SCSP, they issued a warning that perfectly frames this strategic shift.
They were very blunt, yeah. The SCSP explicitly warned that the race is at a critical inflection point.
An inflection point.
It's moving away from a competition of scientific discovery, which, the U.S. largely won with the NIF ignition,
Right.
to a competition for commercial dominance and deployment capability.
And they noted this critical strategic divergence, right?
They did. They said, while the U.S. has the innovative edge in science, China is executing an infrastructure-first strategy.
What does it mean, infrastructure first?
It means they're not waiting for the perfect design. They are building the industrial capacity, the supply chains, and the workforce necessary to deploy reactors at scale, which, as you know, is often a far greater challenge than the initial scientific breakthrough.
So let's delve into that divergence in R&D and talent.
Yeah.
Because that's where the U.S. lead is both undeniable and, paradoxically, most vulnerable.
Mm-hmm.
Where does the U.S. still hold that undeniable lead?
Well, the U.S. maintains the lead in demonstrated fusion performance, and that's thanks primarily to the National Ignition Facility, or NIF, run by Lawrence Livermore National Laboratory.
Okay.
In 2025, NIF achieved ignition performance with an energy gain, or Q, greater than 4.
And for the listener, Q is just the energy out versus the energy in, right?
Exactly. Q equals 1 is break-even. You get as much energy out as you put in. Q greater than 4 is a massive milestone.
It proves the physics works and you get real net energy.
A substantial amount. And the U.S. is the only nation to have proven this viability.
That's not just the hardware, right?
No. Additionally, the U.S. leads in the application of AI and advanced simulation, which is absolutely critical for handling the chaotic physics of plasma and optimizing next-generation machine designs. This is the realm where that U.S. innovative edge really shines, the foundational cutting-edge science.
But if we have the technological and scientific proof, why the panic from the SCSP about China? Why the urgency?
Because China is aggressively focused on the long game.
The long game.
Building the infrastructure and the human capital necessary for deployment, which is a decade-spanning commitment. Their strategy prioritizes people and production capacity over setting scientific records.
So it's a numbers game.
It is. Look at the talent pipeline, for example. China is currently producing 10 times more fusion PhD graduates than the United States.
10 times.
10 times. That is a massive, disciplined workforce coming online every single year, ready to execute an industrial blueprint. You can have the best scientific discovery in the world, but if you don't have the thousands of engineers, material scientists, and technicians required to scale that technology into 20 operational power plants,
the lead is meaningless.
it's meaningless.
And we see that investment in human capital translating directly into academic output, which suggests a shift in the global knowledge center.
Precisely. And while, raw publication counts can sometimes be misleading, the trend here is crystal clear.
What's the trend?
Chinese institutions have massively increased their scale of output. The data shows that over the past decade, China has surpassed the U.S. in its share of publications in the field's premier research journal, Nuclear Fusion.
So it's not just catching up.
This is more than just catching up. This is an active overtaking in the core research landscape, and it reflects their massive public investment in universities and research infrastructure.
And they're integrating this rising technical status with diplomatic and I guess soft power moves, too.
Oh, absolutely. They are strategically showcasing their progress. China will host the 30th IAEA Fusion Energy Conference in Chengdu in October 2025.
And that's the big one, right? The main global conference.
It's the preeminent global international fusion conference. Every major player will be there. For China, it's a tremendous platform to not only display their burgeoning state-supported fusion ecosystem, but also to attract international talent and really solidify their position as the leading nation in the deployment race.
It's a strategic move.
A very strategic move to affirm their growing status as the hard-tech organizer of the 21st century.
This clear-cut comparison brings us to the fundamental difference between the two governance models. We have the U.S., this venture-led, nimble, decentralized, yet maybe fractured model, versus China, the monolithic, state-guided engineering machine. Let's start with the U.S. model, where private capital is doing all the heavy lifting.
In the United States, the philosophy is market-driven and venture-led. Private capital acts as the main engine, accounting for an enormous 91.9% of the funding for U.S. companies.
Almost 92%.
And the total investment into these U.S. firms stands at about $7.57 billion.
So this creates a really vibrant but also diverse ecosystem.
It does. We have 38 of the 68 global private fusion companies operating in the U.S., and they're exploring everything from tokamaks to stellarators to magneto-inertial concepts.
This dynamism is a huge advantage, of course, allowing for rapid experimentation. But the market also demands high returns on pretty short timescales. Fusion, even accelerated, is a decade-spanning infrastructure play. How does that tension manifest?
It creates a reliance on sustained and often speculative private enthusiasm.
Right.
The largest funded firms, Commonwealth Fusion Systems, T8 Technologies, Helion Energy, Pacific Fusion, they account for a massive share of this global investment.
So it's top-heavy.
Very. And while they're innovating rapidly, they are fundamentally accountable to investors who expect exits and returns within a typical venture capital lifecycle.
Which is, what, 5 to 7 years?
Usually 5 to 7 years, exactly. Fusion reactors, however, require massive, sustained, patient capital over 30 years to move from prototype to grid-scale deployment. This reliance on private cycles introduces a strategic vulnerability compared to the state-led models.
And it seems the U.S. government realized that relying solely on venture capital wasn't enough to secure the lead against a state competitor. That realization led to these SCSP recommendations. What did they call for the government to do?
The SCSP recognized that a decentralized venture approach, however innovative, just cannot win this geopolitical race against a unified, centralized state model, so they called for an immediate whole-of-government approach.
And the first recommendation was pretty striking.
It was. The first and most striking recommendation was declaring fusion a national security priority immediately via executive order.
That is a tectonic shift. I mean, it moves fusion out of the Department of Energy's budget cycle and puts it into the realm of strategic, defense-level technology competition.
Absolutely. It signals to the world and to domestic capital that this is critical.
And beyond the political signal, what about the money?
They recommended a massive acceleration investment. $10 billion is needed to bridge that gap between private prototypes and commercial reality.
$10 billion.
This funding is designed to accelerate commercialization, strengthen R&D infrastructure, and fully fund existing programs like the milestone-based Fusion Development Program.
And they wanted to add a new tier to that program, right?
Crucially, yes. They recommended adding a demonstration tier to that milestone program, structured as a capped 50% cost share with industry.
Wait, $10 billion? After decades of saying fusion is too expensive and too complex, the government suddenly sees the need to find a $10 billion bucket. What changed their calculus so drastically?
The realization that the cost of losing the race is infinitely higher than the cost of funding it. They estimated that initiating construction on more than one industry-led demonstration plant by the end of 2028 would require approximately $4 billion in government funding.
Assuming they capped 50% cost share.
Exactly. This is the government attempting to de-risk the deployment phase and provide the patient capital that venture funds just cannot. The U.S. strategy remains private sector-led, but it now acknowledges that a significant coordinated public infusion is required to move from laboratory science to operational power generation ahead of the rival model.
So that's the U.S. model. Dynamic, decentralized, but ultimately having to retrofit a centralized strategy onto a venture framework. Now, if we turn to the Chinese model, it presents the ultimate contrast, the state-guided infrastructure-first approach.
In China, the state command structure dominates from the very outset. They don't wait for market signals, they define the market.
Right.
A substantial 77.3% of all Chinese fusion funding is categorized as either public or public-private.
And the total amount.
Since 2023, the state has mobilized at least $6.5 billion, and many experts think this is a conservative estimate given the lack of transparency.
Some suggest it's closer to $10 billion.
Some do, and this investment is not speculative funding hoping for a quick return. It is mobilized capital earmarked for physical infrastructure that adheres to a centralized 30-year engineering roadmap.
That level of state command is nearly unimaginable in the Western context. And what are they spending that massive mobilization on? It sounds like they're taking multiple giant shots on goal across different technologies.
They are building an entire ecosystem from the ground up, ensuring every strategic component is domestically controlled.
Okay, how?
First, look at the centralization of power. They announced a staggering $2.1 billion investment in a single new state-owned consortium, the China Fusion Energy Company, or CFEC.
$2.1 billion in one shot.
That single public investment is nearly triple the U.S. government's entire annual fusion energy budget request for FY 2026. That shows the intent. Consolidating resources for maximum execution efficiency.
That one figure alone just highlights the difference in scale and intent. They're deploying capital with a singular strategic focus.
Precisely. And now look at the physical projects. Construction is underway on the burning plasma experimental superconducting tokamak, or BEST, in Hefei. It's expected online in 2027.
And BEST is a big deal because...
Crucially, BEST is designed to reach a Q between 1 and 5. As we discussed, Q equals 1 is net energy output, the holy grail.
Right. And while the US NIF got Q greater than 4 with lasers, this is different.
Very different. BEST is aiming for this breakthrough using magnetic confinement, the tokamak, which is the approach most people see as the most scalable for continuous power. Achieving Q greater than 1 in a tokamak represents the transition from a science experiment to a real engineering prototype.
But the real strategic move, the infrastructure first play, isn't really BEST itself, is it? It's the surrounding industrial ecosystem.
It is the ecosystem. On the very same science campus, the $570 million Comprehensive Research Facilities for Fusion Technology, or CRAFT campus, is nearing completion by the end of 2025. CRAFT is the strategic differentiator. This facility isn't about setting scientific plasma records. It's designed solely to test materials and components. It's about the mundane, repeatable manufacturing capacity required for industrialization.
So if the U.S. is focused on getting the best design, China is focused on mastering the manufacturing of the tens of thousands of complex pieces needed to assemble a commercial reactor.
Exactly. You have to ask, why is building the part harder than solving the physics?
Right.
Because a commercial reactor needs components, superconducting magnets, vacuum vessels, robotics, specialized shielding that can operate reliably under extreme stress for decades. This requires repeatable industrial-scale manufacturing capability. China is building that foundational industrial base now, ensuring domestic supply, while Western private firms are still largely relying on niche custom fabrication.
And they are diversifying their bets. They're not neglecting novel or even hybrid concepts.
They are casting a very wide strategic net. Take the Xingguo project, a 100-megawatt hybrid fission-fusion reactor planned for Nanchang.
That's targeted for 2030, right?
For 2030, and it requires an estimated $2.76 billion.
Hybrid reactor.
Yes. It requires lower fusion gain to be productive, which makes the engineering roadmap shorter. But it also generates significant quantities of special nuclear material, which adds a layer of strategic complexity and potential geopolitical leverage.
And what about inertial fusion?
They're investing heavily there, too, by building a NIF-style laser research facility in Mianyang. This facility not only advances energy research, but also provides crucial data for nuclear weapons simulation and design a clear, dual-use technological advantage.
The Chinese strategy seems clear, then. Achieve scientific parity, then leverage state capacity to build the entire industrial base and supply chain to dominate the market.
Yeah.
And that leads us to maybe the most chilling strategic threat inherent in this competition. The control over the physical hierarchy, the supply chain itself.
This is where the Western vulnerability becomes acute. Fusion is not just about plasma. It requires highly specialized, heat-resistant, and conductive materials and components. China has positioned itself aggressively to control critical links in the future fusion supply chain through control of raw materials.
So even if a U.S. firm innovates the best design,
they may be dependent on Chinese inputs to manufacture it.
Give us the hard numbers on that material control. Which materials were we talking about and why are they so critical?
We're talking about the materials needed to line the fusion chamber, the plasma-facing components. They have to withstand a 100 million degree plasma bombardment. Look at tungsten and vanadium, both key candidates for this purpose. China produces 80% of the world's tungsten supply and 67% of the world's vanadium.
80% of tungsten.
So if you want to manufacture commercial-scale fusion reactors, you are immediately dependent on Chinese exports for the physical integrity of your machine.
And what about the fuel itself, the tritium breeding process? That seems like an even more fundamental strategic bottleneck.
It is the ultimate Achilles heel. Tritium fuel is bred using enriched lithium-6 within a blanket surrounding the reactor.
Right.
Currently, there exists no commercially available enriched lithium-6 supply in the United States.
None.
None. It is only produced in China and Russia.
So if the U.S. private sector starts building reactors that rely on tritium breeding,
they face an immediate geopolitical bottleneck right at the fuel source. Imagine having a massive new energy source, but the raw fuel component is controlled by a strategic rival.
And this dependency extends into the high-tech components for inertial fusion, like those laser systems we discussed.
Absolutely. For inertial fusion concepts, the driver lasers require specialized diodes, and China dominates the raw materials required for those diodes: gallium, indium, and germanium.
And they just put export controls on gallium and germanium.
They did, which underscores this dominance. The SCSP report rightly urges the U.S. government to act immediately to secure the domestic supply chain for key components: high-temperature superconducting tape, power electronics, beryllium, lithium, and tungsten. Otherwise, you risk ceding control over the essential means of future global energy production. The Chinese strategy has focused on controlling the Earth itself to control the sun.
So we have the two giants, the dynamic but perhaps strategically incoherent U.S. venture model, and the unified resource-controlling China state model. Now we have to introduce the third major player, the European Union, which presents a fascinating strategic duality. Unparalleled historical public investment, yet a private sector that seems to be lagging the pace set by the U.S. and China.
That's the strategic paradox of the EU. They have built deep, world-class industrial capacity through public contracts, but they lack the internal private capital engine to scale it commercially.
So what are the numbers?
The EU's private ecosystem is significantly smaller. It's raised only 567 million euros across 8 companies, which amounts to just about 5% of global funding.
5%. They're almost bystanders in the capital race. And when you look at the size of the investment rounds, the sheer scaling problem for Europe becomes immediately clear.
It is a profound structural challenge. The data shows that the average EU investment round is 30 times smaller than in China and 3 times smaller than in the US.
30 times smaller.
Yes. The demonstration phase of fusion, moving from a proof of concept to a working reactor, is measured in billions, not millions. This gap in access to patient, large-scale private capital poses a huge bottleneck for the EU's ability to transition its scientific expertise into commercial reality.
And what's even more telling is the direction of capital flow. European money isn't just staying home, it's actively funding their competition.
That's right. The EU has a significant negative cross-border investment balance of 74 million euros.
And most of that is going to the U.S.
A 105 million euro negative balance specifically with the U.S. This means that European capital money that could be funding European innovation is actively flowing out to fund foreign fusion ecosystems.
Particularly the larger, more mature U.S. venture market.
Exactly. This reflects either a lack of large, investable domestic projects in Europe or, more likely, a structural preference by European investors for the perceived higher returns and security of the U.S. venture environment.
Either way, EU money is accelerating the U.S. lead. It's an interesting inversion of global investment. Now let's look at the technology focus within the EU private sector. Globally, investment overwhelmingly favors magnetic confinement fusion, or MCF, which has attracted about 6.2 billion euros. Is the EU following that trend?
The EU private sector is actually inverted from the global trend.
Inverted, how?
While large public projects across the world favor MCF, the EU private sector sees inertial confinement fusion, or ICF, attracting 390 million euros. That's more than double the amount invested in MCF companies in the EU private space.
So European venture capital is charting a different course.
It suggests they are, potentially exploring alternative, higher-risk, high-reward pathways that bypass the established public sector tokamak designs.
We see leadership coming from the UK, with Tokamak Energy focusing on MCF, and German-based firms like Marvel Fusion and Focused Energy leading in ICF.
That's right, but even those leading German firms often have strong operational ties and investments linked to the U.S., again showing that porous cross-border flow.
Right.
The UK's success is distinct, but it highlights that geographically, European innovation is fragmented compared to the consolidated approach in the U.S. and a centralized control in China.
Okay, let's pivot to the element that fundamentally differentiates the EU. The massive foundational public investment in hard industrial capacity. This is the great equalizer.
This is the crucial counterpoint to their lagging private sector. The EU has invested a colossal amount in the ITER supply chain via Fusion for Energy, or F4E.
And what does that look like?
Since 2007, they have executed approximately 1,300 contracts for components vital to future reactors, superconducting magnets, vacuum vessels, cryogenics. This commitment amounts to a total investment of 6.82 billion euros.
6.8 billion. Okay, so let's compare the total financial investment between the US and the EU. Let's combine both the private company investment and the public investment into the ITER supply chain, because the total financial muscle might surprise people.
The total financial figures are remarkably similar.
Really?
Yeah. The EU total, combining that 567 million in private fusion and the 6.82 billion in the ITER supply chain, reaches approximately 7.389 billion euros.
Okay. And the US?
The U.S. total, with its 6.109 billion in private fusion and approximately 1.293 billion in its ITER supply chain contribution, totals around 7.402 billion.
So the overall financial investment is comparable, but the distribution of that capital is radically different, and that reveals everything about the strategic differences.
Absolutely. The U.S. relies overwhelmingly on private equity to drive the innovation frontier, with the government trying to retrofit support for deployment.
Right.
The EU, on the other hand, relies on deep public investment to build a world-class industrial supply chain. The EU strategy has effectively created the world's most advanced factory floor for fusion components, a high-performance hard-tech industrial base all through public funding.
So to sum it up, the U.S. has the most innovation and the most market pull. China has the most centralized funding and material control, and the EU has the best supply chain manufacturing capability, but lacks the commercial vehicle to utilize it.
That is the perfect strategic summation. The challenge for the EU, and they identify this in their own reports, is the long-term sustainability of that public industrial base.
How so?
That multi-billion euro capability was built on contractual terms for a single massive public customer, ITER. If private commercialization within the EU or global commercial demand for those specific high-tech components doesn't materialize, that industrial base, that crucial physical capacity, will struggle to be sustained once those initial contracts are completed.
Which brings us back to the fundamental question of governance and economic models. We've spent this time dissecting the fusion race, and we keep circling back to the behavior of capital.
Yeah.
Why is U.S. private capital so nimble yet seemingly fickle? Why are European investors sending money overseas? Why can China command decades-long roadmaps? This entire phenomenon is a manifestation of two fundamentally different global economic approaches, referenced in the opening monologue: Western financialization versus Eastern hard-tech industrialization.
And the connection between a $7 billion venture fusion market and a complex macroeconomic theory like post-Keynesian economics is absolutely essential here. We need a bridge.
Right.
The venture-led fusion model is operating under a specific set of financial incentives: high risk, high return, fast exit, usually within a 5 to 7 year window.
But fusion infrastructure requires patient 30-year capital.
Exactly. The theoretical structure that explains why Western capital prioritizes short-term financial returns over 30-year infrastructure builds is the model of financialization.
Okay, so let's define financialization using that PKE framework, but keep it grounded in the strategic context.
Right. Financialization in the PKE framework is defined as the increasing role of financial motives, markets, and institutions in the operation of domestic and international economies. Fundamentally, it's characterized by the financialization of households.
What does that mean?
It means rising household debt and skyrocketing property prices substituting for wage growth and real savings.
So it's not just about Wall Street making money. It's about shifting the basis of domestic growth onto household debt and financial assets rather than industrial production.
Precisely. We contrast financial accumulation, like a house price boom generating paper wealth, or a corporation doing stock buybacks, versus real accumulation,
Which is
tangible business investment in things like new factories, infrastructure, R&D labs, and yes, fusion reactors. And empirical evidence, based on decades of PKE analysis, shows a clear trend. Financial payouts like dividends and buybacks, and the general shift toward financial accumulation tend to have contractionary effects on non-residential investment.
why build a factory with uncertain returns in 15 years when you can boost the stock price and executive bonuses through financial maneuvers today?
That's the structural preference.
Yeah.
And it's the backdrop to the entire Western approach to capital allocation.
This sounds highly relevant to the U.S. model, where private capital focuses on maximizing shareholder value over the long-term national strategic imperative of building fusion infrastructure.
It is the defining macroeconomic feature. PKE analysis highlights how this financialization creates stability problems, shaping macroeconomic stability in advanced economies through two mutually dependent and intrinsically unstable growth models.
And we saw these play out in Europe before the 2008 crisis.
Clearly evident in Europe between 2000 and 2007, and they characterize the fundamental structure of Western demand.
Let's break down the first one, the debt-driven regime, the credit card economy.
This regime was characteristic of Southern Europe, Spain, Greece, but also Anglo-Saxon countries like the US and the UK. The core mechanism is strong household financialization fueling consumption.
Give me an example.
Take Southern Europe, where household debt increased by a staggering 62.2% in the pre-crisis period. This means growth wasn't coming from industrial exports or stable wage increases. It was driven by wealth effects from the property price boom and just debt finance consumption.
And the outcome of this debt-fueled consumption, they were living beyond their means.
The outcome is typically large current account deficits, like the negative 5.5% seen in Southern Europe pre-crisis. The model is intrinsically unstable because it requires constantly increasing debt-to-income ratios, an asset bubble that must never pop.
And when it pops?
Once the asset bubble bursts, as it did in 2008, it leads directly to a domestic debt crisis, triggering massive post-crisis deleveraging. We saw Anglo-Saxon countries in Southern Europe forced to reduce household debt by 21% and 11% respectively in the post-crisis period. It demonstrates the violence of that deleveraging cycle.
The economy is structured for a boom and bust cycle,
Which is antithetical to 30-year infrastructure planning.
Okay, so Western financial power is built on a consumer model prone to volatility, debt, and deleveraging shocks. What about the other side of that duality, the export-driven regime, the Northern European approach?
This regime is exemplified by Northern Europe, particularly Germany. Their mechanism is fundamentally different. It's a focus on maintaining a highly competitive industrial structure, a stable share of manufacturing, and only moderate financialization.
So less household debt.
Much weaker. Northern Europe's household debt grew by only 23.7% pre-crisis. They are the disciplined manufacturers.
And their outcome is the inverse of the debt-driven countries. Massive surpluses.
Precisely. They sustain large current account surpluses averaging 4.1% pre-crisis and actually rising to 5.8% post-crisis. They are selling far more than they buy.
But here's the catch, right?
Here's the critical PKE insight. This model is also fundamentally unstable because it relies entirely on other countries, specifically the debt-driven regimes running sustained deficits and debt-financed imports.
So Germany's industrial stability is dependent on the U.S. consumer taking on more credit card debt.
In a way, yes. The success of the export-driven model structurally undermines the macroeconomic performance of its trading partners, leading to endemic global imbalances and eventual crisis.
So if the U.S. model is debt-driven and the German Northern European model is dependent on that debt, neither offers a stable, long-term foundation for a project as immense and long-dated as fusion energy.
And that is the hard tech synthesis. The Chinese state-led model we examined, the one commanding $6.5 billion for infrastructure, represents a powerful industrial strategy. It's intentionally divorced from the volatility and constraints inherent in both the debt-driven and the dependent export-driven models prevalent in the US and the EU.
This is the third way.
It's an accumulation strategy that prioritizes real accumulation building physical, strategic, industrial capacity and controlling resources over the volatile financial abstractions that characterize Western growth. Their focus is on mastering the fundamental means of future energy production, which in turn underpins future geopolitical power free from the constraints of financial cycles.
So we have two competing definitions of long-term stability playing out in the fusion race. One is based on managing increasingly complex, leveraged debt cycles and financial abstractions, and one is based on managing a 30-year blueprint for technological supremacy and the physical control of the planet's resources.
That is the unavoidable geopolitical synthesis. The fusion race is a direct, real-world comparison of state capacity. On one side, we see governance optimized for managing complex, inherently unstable financial cycles and abstract debt regimes.
Which is necessary for those economies.
It is. The government has to spend its energy mitigating financial crashes and banking crises.
So while the U.S. government argues over funding a $4 billion cost share program to get its private companies across the finish line,
the Chinese government is commanding billions in funding since 2023 for infrastructure projects like BEST and CRAFT, workforce development, and new state-owned titans like CFEC.
it's a difference in priorities that manifests as a difference in physical capability.
Exactly. On the other side, we see a command structure, the Chinese system, capable of relentlessly executing a 30-year engineering roadmap. It's mobilizing capital and talent toward a singular physical goal, mastering the ultimate physical hierarchy of the universe.
A system designed for physical capacity.
Yes, a system designed to create disciplined, centralized physical capacity that is impervious to the short-term demands of shareholder value and the volatility of consumer debt cycles.
And this brings us right back to that chilling thought from the opening monologue. While time and resources in the West are spent debating moral debts, carbon credits, taxes, complex financial regulation, the rival model is investing billions to build their own sun. The risk isn't just ceding a lucrative industry to a competitor.
No. The risk is ceding the capability to control the essential means of future energy production, the entire industrial supply chain for it, and thereby ceding long-term geopolitical power. The Chinese model is demonstrating a path to technological and energy sovereignty that explicitly avoids the volatility and dependencies of the Western demand regimes we just described.
It forces a brutal confrontation with the relative effectiveness of these two governance structures.
It does. The relative success of the state-led hard tech model in achieving this kind of industrial dominance raises a chilling conclusion about the long-term stability and effectiveness of systems built on complex financial abstractions.
Versus those built on disciplined, centralized physical capacity and engineering roadmaps.
The results of the fusion race will be a definitive scorecard on which model provides the most powerful engine for global progress in the 21st century.